Goal number 2, know your retirement budget, and then know how it splits into needs versus wants. And if you're liking this type of video so far, let me know so I can make more like it. Now, on to the third goal. Again, when we were working, we would look at this periodically, most likely. But now, as we're getting closer to retirement, or if we're in retirement, keeping a closer eye on it is important. And that is your net worth. Those tools that I mentioned, like Monarch and the other ones, Tiller and YNAB, they can automatically track net worth. But as a simple reminder, it's what you have minus what you owe. That's debt. That equals net worth. And the goal here is just track net worth number, know what it is, either quarterly or monthly if you can do that. If you've got the tools doing it for you, might as well check it monthly. Now, goal number 4 is to be debt free. Now, whether a mortgage is good debt or bad debt, that could be debated here. But one thing that everyone can agree on is that credit card debt or maybe auto loan debt, there's no advantage to having that, especially for retired people. If you've got the assets saved, create a plan to pay off that debt before retirement. And then one other thing on mortgages, there's a financial factor that works into the plan, right? For financial plan, that's obviously financial related, but there's also an emotional factor. And we'll create a retirement plan for people and see that financially, a mortgage in retirement, it's okay. It's not harming the plan at all. But sometimes clients, the emotional factor will outweigh the financial factor, and they'll decide to pay it off. And that's okay too. There's not a bad decision. Now, obviously, if there's a red flag or yellow flag, we'll make it aware, and then they could solve that problem. But if it's not, it's really, where do you feel? Really, it's around feelings and emotional. What delivers the most peace of mind and doesn't harm the plan? That's a good decision. So if you're working with a planner or using one of the online tools like my favorite retirement planner below, look at the plan and do some of the what if scenarios. What if you did pay it off early? Or what if you didn't? How does that impact the long-term plan there? And that brings us to goal number 5. It's nice to have the Monte Carlo image like this and show a success rate, for your 99% success rate, always good to see. But we also want to have a draft cash flow projection. That's goal number 5. It's map out future cash flow, meaning what accounts are going to be sending money at what time or what age. A simple way to do this is list all your assets on the left side and then the value there. And then to keep it simple, even though I don't love the 4% rule, how much would or could, not Social Security, that's just fixed numbers you can find out. But if the rest of these investment accounts, what's 4%? What does that come out to for each one of those accounts? What's the total estimated income there? And take that number, compare it to the budget that you came up with, the estimated budget, and see, are you close? Are you far off? It's just good to know. That's just doing this is a goal in itself. The next step is to get a little bit more detailed. Maybe if you're working with a planner, something like this, where you've got the accounts here again, and then you've got your ages here, and what account and when are you going to start? It all depends on your income plan. It's always changing, or it's specific to each one of you, but that's just an idea to look at. One way to visualize when the money is going to be coming to you and when's the ideal scenario there. As you can see, just as an example, a lot of times with Roth IRAs, if you've got kids, if you want to pass money on, those are sometimes the last to spend. Tax-free money's passing on to kids. So sometimes that's the last thing we'll see there. But anyways, let's move on to the next goal. And that is to draft a real retirement plan, one that factors in all the things we went over so far. So it's all your assets, your expenses, the investments, how they're invested, and that helps you determine the proper allocation, how you should be invested. And that gives you the goal investment return. For a lot of our clients, it's what's the minimum rate of return we need to still see the highest chance of success in the real plan. So the 2 ways to do this, one is work with a planner, get something detailed with all the what if scenarios like this tool here. Another one is a DIY option, and it's using Bolden, the link below. And it's, if you're not working with a retirement specialist, then you can plug in your numbers, and that gives you a pretty good idea of it's actually the best retirement planning software I've seen that's consumer facing, where anybody can use it. There's, I think, a 2-week free trial. But take a look at the website, see if that could work for you as step number 1. And both those options, they can help explore multiple what if scenarios for your future, like life expectancy, inflation, expectations, market conditions, your risk tolerance, and the withdrawal strategy. So either one of those could work. The next goal is actually not about you. The first 6 were about you. This one is about the people that you love. And we see so many cases of this where things go wrong when someone passes away, and it has to do with wealth and the kids. And it can cause a lot of distress, and it's just not preparing your kids or your heirs the right way. So goal number 7 is what I'd call buttoning up your estate plan. And that just means making sure, doing a review of wills and trusts, making sure it's in order, making sure your heirs know where to go when you pass away, if you pass away, or if you get sick where you can't act on your own behalf. Make sure that they're prepared and they know what to do. And if you've got the trust, make sure it's updated. Check with your successor trustee and make sure that's still the person you want it to be. And do the beneficiaries match with the intended, what you want to have happen? Doing a review each year is actually not a bad idea, just to see amounts for each beneficiary, what they're getting. Doesn't hurt, and it only takes a few minutes, especially if you're working with somebody. But just reviewing this at least every few years is really important. And if you don't have any of the documentation now, it's a simple process. Find an attorney and just make sure your wishes are going to be met.